Hey, Adam Hoeksema here from ProjectionHub, and this is the fifth video in a six-part series on how to buy a small business with an SBA loan. In this particular video, we're going to be focused on how to create a lender-ready loan package. We've already talked about how to buy a business in general at a high level, how to find a business, how the SBA process works, how to do financial due diligence. All of those videos we'll put in a link in the description of the video below. So if you haven't watched those, I'd recommend at least watching a couple of those past videos just to set the stage here for now that we're at the point where, okay, how do we get this deal in a presentable format that's going to be convincing to an SBA underwriter? Yeah, so that's the plan for today. Before I dive into that, just a little bit of my background. I was an SBA lender myself for 12 years, closed about 1,500 SBA loans. There's a picture of me here winning some SBA award here with the state director of the SBA. Here in Indiana. And while I was a lender, I also started ProjectionHub, where we help clients create financial projections, work on business plans, and ultimately help through the SBA process. A few years ago, I stepped out of my lender role and working on ProjectionHub full time. And a lot of the deals that I get to work on are clients who are looking to acquire a business. So, and particularly with my SBA background, I want to put together some content all in one place that's kind of comprehensive to give new folks that are looking to buy a business just a place to kind of watch the whole process unfold and how does that work. One, to make that free and available. So that's what this series course is here. These are the 6 courses that we've put together. Again, I'll put the links in the description of the video below to the last 4, and then the final one, when it's released, will be included as well. So with that, the objective for today, by the end of the session, we want you to understand how lenders are going to evaluate your deal. We want to know what documents you're going to need to prepare, how to build the acquisition financial projections that will be required in the business plan, and then what it means to be pre-qualified for a deal by a lender, what that means and what it doesn't mean. And so we'll go through that today. All right, so lenders kind of look at a deal. You can think of about this 3-legged stool. Leg number 1 is, first, does the business cash flow? Like, SBA wants deals to cash flow. They have to demonstrate how the business is going to be able to repay the loan from cash flow. Okay, so it doesn't matter how much collateral you have or how great your personal financial statement is. If you put a deal in front of an SBA lender and you show that it doesn't cash flow and you're just going to try to make up for it with, personal savings or personal income, it's not going to get approved. It has to. The business needs to be able to cash flow the loan. And they measure that cash flow by a term called debt service coverage ratio. We've talked about it in the last couple of videos, but you'll want the debt service coverage ratio to be 1.25 or higher. You want revenue to be stable or growing. So that's kind of leg number 1. Leg number 2 is the buyer's strength, personal financial strength. So what's your credit score? Needs to be probably 650 or above. You need to have industry experience, or you need to have a plan to mitigate the lack of industry experience. So if you are, an accountant buying a plumbing business and you are you're not a plumber, you're not a licensed plumber. Okay, what is the plan then? Are you going to have a business partner who is a licensed plumber? If you're just going to have a manager who's a plumber, but not an owner, you're really going to need to have a really compelling case how you're going to keep that key employee because they have the license. And without them, as an accountant like myself, I wouldn't be able to do plumbing work. So that industry experience is really important. You need to show that you have a sufficient down payment and strong personal financial statement to rely on. And then the deal structure. Leg number 3 is the deal structure. Is the purchase price reasonable? Is the valuation of the business reasonable? Is it going to appraise appropriately? Is there collateral? It doesn't have to be fully collateralized, but if it's not fully collateralized, it better be strong somewhere else. Are the seller add backs reasonable and legitimate? And do the terms make sense for you as a buyer and for the lender? So let's look at kind of your credit score and personal history first. So, minimum expectations, I'd say 650 credit score. If you can be at 680 to 700, that's a lot better place to be, a lot more certainty towards getting to closing. I think common issues that are going to hurt you, if you have really any more than like one late payment, it's like, okay, if you had one late payment, 30 days late, maybe it was an accident. If you've got more than one, you're kind of like, all right, now we've got a history of late payments. Or if you have anything that's gone to collections, that's going to be an issue. Recent bankruptcy almost rules you out. I mean, it doesn't automatically rule you out by the letter of the SBA, but it's going to be tough if you've got a recent bankruptcy or any past taxes that are due. So how do you address those issues? You can pull your own credit report. There's a variety of ways to get your credit score. You can dispute errors if there are errors there, pay down high balances on credit cards. So if you've got high utilization rate on credit cards, that's probably the quickest way to make a difference on your score. From what I've seen is pay down those highly utilized credit cards that could have a big impact pretty quickly. And then, don't let the deal go to underwriting without telling the lender ahead of time, hey, you're going to see this on my credit report. Yep, I missed these 2 payments. It was a fluke, or it was this difficult time 3 years ago. We're past that because of a health issue or whatever it might be, or I lost my job, but that's in the past. We got past that, and we've got good credit history since then, that type of thing. So you want to hit that ahead of time in my recommendation. Okay, if your credit score is below 650, you're really probably going to need a business partner, a cosigner with stronger personal credit. Okay, from Collateral. SBA's collateral rule is that the lender must take all available collateral until the loan is fully collateralized. This is for any loan that is going to be over $350,000. Loans below $350,000 have different rules, and different lenders may not require anything beyond just all business assets. So they may not go towards your personal assets and try to fulfill or fill a collateral shortfall. But anything over $350,000, lenders are required by the SBA, if there's a collateral shortfall, to go and dive into the financials of the individual owners, any owner who owns 20% or more, and take all available collateral until the loan's fully collateralized. So what that typically means is your house. If you have equity in your home, that's likely on the line. And, honestly, even if you don't actually have to pledge the house, but you're personally guaranteeing a federal SBA loan, you're effectively putting all your assets on the line anyway. So just keep that in mind. So personal guarantee is going to be required for anyone with 20% or more ownership. You are personally on the hook if the business fails. And so, this is not something you just go into willy-nilly. I mean, it's a serious thing. It's a federal loan. If you default on a federal loan, it's going to make life harder for you in a whole bunch of other ways in the future. And so you really want to be sure. You want to be confident and not bite off more than you can chew. The question about that, what available collateral means. So it's your personal assets with equity. So home equity, they're not going to go after like your 401k or college savings accounts, like 509 plans. They're not going to go after that. But the home equity is the most common. Now, sometimes what we see people do is they take out a home equity line of credit, and that kind of eats up the equity in their home. And so then if there's not at least 20% equity value in the home, like let's say there's only 5% equity in the home between what it's worth and what you owe on it, SBA won't take it. They're not going to be required to take it because there's not really anything there. So if you don't own a home, it's not a deal killer. It just means the deal is under collateralized. And so it just means everything else needs to be stronger. The debt service coverage ratio needs to be stronger. If it's a brand new startup, that's where it gets really tough without collateral. But if it's an acquisition, which is what we're talking about here today, acquisitions have a history. And if that history is strong and stable and cash flows, then there's a lot of lenders that can get comfortable without requiring the deal to be fully collateralized. Okay, relevant experience. So you are going to need to prove that you have experience to run this business. I mean, most SBA loan acquisitions are situations where the business has been operating, it's been profitable, it's been cash flowing. And so really what you're trying to do is demonstrate with your resume, with your business plan that, hey, I'm going to come in here and buy this business and I'm just not going to screw it up because it's already working. It's already working. It already should cash flow the loan, the proposed loan. And so as long as you can convince the lender you're not going to screw it up, you should be able to demonstrate that you have sufficient experience, right? So what I often say, the best case scenario is an employee buyout. Lenders like that the most because you already know the customers, you know the vendors, you know the employees, you understand the operations. It's probably the lowest risk for a lender. One thing I would say about employee buyouts is it tends to be that the employees then maybe lack some financial strength because they're an employee of a small business. So they may not have, $3 million net worth on their personal financial statement, whereas sometimes there's financial buyers who have more financial strength, but less experience, less specific experience in the industry or in that particular business. If you have direct relevant experience, so let's say you've been managing a similar type of business, but not this particular business, that's great. That's great relevant experience. And then I'd say the weakest scenarios, hey, I've got no direct industry experience, but maybe I've been in the corporate world and finance and I want to, I've heard about buying a boring business and I want to buy, a laundromat. You're really going to rely on your personal financial strength in that sense, because you have no direct industry experience. You're going to need to try to hire consultants and experts to help guide you to round out your team and your expertise and strengths there. And then if you can hire a manager who has industry experience, that's really helpful. So if you can retain the seller for a training period of 3 to 6 months, that can be really helpful as well in mitigating that risk. You will want to kind of emphasize those transferable skills. So if you say, hey, well, I've managed people, I've hired, I've fired, I've done customer service, I've done sales. Okay, that is relevant experience in most acquisitions. Okay, so here's kind of the core document list of things you're going to need to pull together. A personal financial statement, and there's an SBA form 413, which is the form that you'll need to fill out. The last 3 years of your personal tax returns. You need the full tax return, all the schedules included. You need a professional resume that's highlighting, how your experience as it is relevant to this particular business. You need the business documents. So the last 3 years of business tax returns, the profit and loss and balance sheet for the business for the year-to-date financials. And then you need, what is the seller's discretionary earnings or what's the cash flow calculation with all the add backs and explain those. You need a letter of intent or a purchase agreement draft. And then you'll need some documents specifically related to the loan request. So kind of a sources and uses. So how are you going to source all of the funds needed and how are you going to use those funds? So how much is going to be a loan? How much is equity injection? How much is a seller note? You need a financial projection. You need at least a 2-year financial projection. We will put our acquisition projection template in the description of the video below here. We'll put a link to that. And that's a 5-year model, both annual and monthly. Then you'll need a business plan that is really focused around the acquisition. So in my opinion, the business plan does not need to be about, here's all the great things we're going to do and add and change. That almost scares the lender away. Again, this business has already been operating in theory, is already profitable in theory, right? And so your job in the business plan is to say, hey, this is already a great business. I'm going to come in here and here's how I'm not going to screw it up. When you start talking about all the things you're going to change for a business that's already working and cash flowing, that just creates risk in the lender's mind. So I would not overdo it on all the things you're going to change in your plan. And then finally, your kind of new entity formation. If you're doing a purchase, just an asset purchase, if you're purchasing the assets of the business, you'll need to set up a new entity. All right. So in order to build the acquisition projections, you start with the last 3 years of historical financials or tax returns. And then typically we want to make sure that it cash flows already. And then a lot of times I just use a 3% inflation rate on revenue and expenses. And then for the expenses, we just start with this. The expenses are going to be, in line with the historical percentages. So if it's a restaurant and food cost was 30% of revenue, going forward, we're not going to all of a sudden make it 20% of revenue. We'll keep it the way it has been. It's been 30% of revenue in the projections. The adjustments that you might make are things like if the seller's leaving, so the seller's salary is going to go away. If there's discretionary expenses that are provable, documented, from the seller. You can exclude those going forward. And then you're going to have to add in your debt service, your loan payments, and then also working capital needs. And lenders want the debt service coverage ratio to remain above that 1.25 in year one. They want a clear explanation of your assumptions. So, we kind of have a method of doing that, line by line on the revenue and the expense line by line. We'll say, here's how we came to this assumption or this expense. And it may just be as simple as we use the same percentage of revenue for cost of goods sold as we did in the past. So this is kind of a lot to look at. The main thing I would want to point out is just that the idea here is the lender is going to be looking at the historical financials, and you want the historical financials and the projected financials to look similar. You don't want to have, hey, here's a business that was doing $500,000 of EBITDA, and in year one is going to do $2 million of EBITDA. That's going to throw the lender off. You don't need to do that. You just need to show that you're not going to screw it up, right? So keep it simple on the projections here. Then on writing a concise business plan, again, don't overdo it on all the things you're going to change. You want to talk about who you are, what you're buying, why it makes sense for you to buy it, why you're the right person to buy this business, and trying to talk through, is it a stable business? Are the customers stable? Are the employees stable? And what's your transition plan? And so how are you going to learn if you have gaps in your understanding of the business? How are you going to fill those gaps? How are you going to mitigate those risks? That's what you want to be focused on, in my opinion. Okay, so what do lenders actually care about then? A few things here. I'd say, is the price reasonable? So you can kind of compare, here's what we're paying for it, and here's some valuation, multiples that seem reasonable for our industry. Is the business stable? Does it look like it's constantly changing year over year, very dramatically? If you can show monthly financials and, hey, every month looks about the same, that's great. That's music to a lender's ear, because the lender's payment is going to stay the same every month, right? Your loan payment's the same. And so you want to, if you have a very volatile business or very seasonal business, you just have more work to do, more explaining to do. So, projections become more important if it's a very seasonal business. You need to be able to show, hey, we understand we're going to maybe lose money some months, but we're going to make so much money in that primary season. And so we know we're going to have to save this amount so that we can continue to cash flow and repay the loan throughout the full year. Can you afford this? So that's really talking about your deal structure, your down payment, your debt service coverage ratio, and then do you know what you're doing? Does your experience and your transition plan make sense to a lender and kind of show confidence that you know what you're doing? All right, so finding the right SBA lender. The reality is there are hundreds of banks and lenders that can do acquisition loans. Some banks will do very few, and some banks will do a lot. Some banks love certain industries and hate other industries. Some banks are kind of industry agnostic. Some lenders will get more aggressive in areas like where they have a branch presence. So in a certain area where they have a branch presence, they might be very aggressive, and less aggressive where they don't have a branch presence. So there's some nuances to why that is probably the case that we don't need to get into right now, but just know you might look at a lender list and say, oh, this bank has done a lot of loans to these types of businesses nationally, but maybe most of that's happening in their area where they are physically located, and they're only picking the cream of the crop outside of their physical location. So some examples of kind of the well-known acquisition-friendly banks. Live Oak Bank is kind of the behemoth here, known for acquisition lending with SBA. Huntington National Bank is a top SBA lender, typically every year in terms of at least the volume of loans. They do a lot of acquisition lending as well. And then, you can, so if you've got a deal that you think, hey, this is a really tight deal, it might make sense to find a local community bank or credit union that are smaller, that, they don't get as much deal flow. And so they may be willing to stretch a little farther on a deal in their community that they like, but is a little tight on cash flow. Whereas, Live Oak Bank may say, we just don't need that volume. We don't need to take the risk on a tight deal. And so that's something to consider. Red flags for lenders. If somebody says, hey, we do SBA, but they're only doing real estate backed loans? Are they willing to do loans that aren't fully collateralized or close to fully collateralized is a question. Are they not used to actually doing many acquisition loans? And then do they have a dedicated SBA department, or are they outsourcing that? It doesn't mean that, there are good SBA lenders that outsource a portion of the SBA work, but it's just something to know. There's if there's extra parties, extra decision makers involved, it can maybe slow down the process. It could potentially, it just creates, more distance between you and the decision maker. So we've put together a free SBA lender finder tool. We take the publicly available SBA loan data and get it into this little tool where you can sort and filter it. We'll put a link in the description of the video below to that. But it's really cool. You can sort by state, industry. You can pick if it's an acquisition or a startup, for example, and it will sort and filter the lenders who have done the most loans in your area, in your industry for acquisition deals. And that'll give you a good starting point. Now, one thing I always like to say is just finding a name of a bank that has done a lot of deals that look similar to yours is helpful, but ultimately, you need to work with an individual person, an individual lender. And so that can be a challenge sometimes, particularly if your deal is a little smaller, on the smaller side, less than $1 million. The top lenders, they're busy. They're busy with good deals, big deals, and they would prefer to use their time on the biggest, best deal they can. And so sometimes it can be hard to find a lender who can get excited and work hard for you on a $500,000 or less deal. So if you have a deal that's a little smaller and you'd like some help finding a lender who you think could be excited about your deal, feel free to reach out to me. Email adam@ProjectionHub.com. Love to help you try to find a lender who could be a good fit and work with you through that. So just a little bit more about this particular SBA lender finder tool. You can see a screenshot of how that works. And the last thing I want to really hit on here, I think, is SBA pre-qualification and what that means. So, I like to think about, if you're buying a house, you don't just pick the coolest, best, biggest neighborhood and just start looking at houses, because you got to know how much you can afford. Can you afford that or not? And so what you often do is go to a bank, go to a mortgage lender, get a pre-qualification letter where they've looked at your financial information and they're deciding, hey, this is how much you can probably afford. It's not a formal approval because you don't have the house yet, right? So similarly with an SBA loan, you can, even if you don't have a particular deal yet, or if you have a deal that you're looking at and you want to get pre-qualified for that, it's not a formal approval, but we pull together documents, tax returns, personal financial statement, resume, and a lender can say, yep, here's a term sheet. Upon further due diligence and underwriting, if everything checks out, we think we could lend up to this amount. And so, I think that's really helpful because it gives feedback on a deal structure. As you're negotiating with the seller, you can know that your structure is likely to get approved. Otherwise, you're going to agree to a deal structure with the seller. If you haven't done this a lot before, you're probably going to agree to a structure that the lender is going to say, oh yeah, we can't do that. And so I like to involve the lender early on in the process, try to get that pre-qualification process. And so, we can help you through that. And, hopefully you now know this is about what I can qualify for. Now can go out shopping and kind of structure my offer around my pre-qualification amount. Okay, so that is it. That's the end of course 5. We are coming to the finish line here. So the final course. So really, at the point you've submitted your lender package to the lender to underwriting, then it's getting approved through underwriting and closing the deal. And so that's what we'll be talking about in that final course, kind of going through the SBA underwriting and approval process. And then what is it going to take? How long is it going to take? And what are the key things to look out for? So I hope this has been helpful. We'll again put all the links to resources and other videos in the description of the video below, so you can check those out. And feel free to reach out to me at adam@ProjectionHub.com. And if you felt like this video was helpful, it would be awesome if you would like the video. That helps us share this with more folks, and subscribe to the channel. We're going to be publishing more videos related to acquisition of small business, and would love to have you there for that. So we thank you and hope we hear from you. Thanks.